to be joined by Dr. Jack Rasmus. He wrote a opinion piece yesterday called The Global Financial Asset Deflation Prelude to Next Great Recession. Jack is author of quite a few books, most recently The Scourge of Neoliberalism, U.S. Economic Policy from Reagan to Trump. And that is published by Clarity Press. Dr. Jack Rasmus, you've got a website, right, where people can find many of your writings?
Yeah, they can go to my blog, which is simply jackrasmus.com, and from there they can go to my website for my video and audio files, podcasts, and they can also go from my blog, jackrasmus.com, to my radio show, which is Alternative Visions.
Been predicting the possibilities that we're facing quite clearly as of today. It's been talking about the fragility of the world economy. And today, Monday, by the way, marked the 11th anniversary of the market hitting the bottom after the 2008 financial crisis. The Dow Jones Industrial Average today, I believe, closed with a loss of some around 2,000 points. And that was just part of a global market rout that saw spiraling sell-offs in the energy sector amid the biggest drop for crude oil prices since the Gulf War in 1991. So Jack has talked about how for the past decade the underlying fragility of the global economy has been masked by perpetually low interest rates. Cheap money has been the fuel for rocketing asset prices, shares and bonds in particular, but it hasn't done much to boost investment in the real economy. Productivity growth has been historically weak. So it was all behind the scenes. What's happening with the world economy was slowing even before China came clean about the true threat posed by the coronavirus. I think there's no longer a question of whether or not there's going to be a further slowdown, but it's a question of how deep and long that slowdown might be and the impact on working people. So, Jack, we wanted to get you to share some of your thoughts with us.
Well, in 2010, I wrote a book called Epic Recession. Really analyzed the crash of 2008 and 9 from the perspective of how financial cycles impact the real economy and vice versa, and how both tend to exacerbate each other and produce a contraction deeper and longer. And then in 2016, my book, Systemic Fragility in the Global Economy, really described how financial investment was sucking away real investment that produces jobs and income and wages and so forth, how in the global economy, in capitalism, 21st century, becoming increasingly financialized, which to me means creating a new financial structure globally in which a new finance capital dominates, sucks out real money capital into financial markets and speculates, creating bubbles. And then in 2017, I wrote Central Bankers at the End of Their Ropes, Monetary Policy in the Coming Depression, which described how central banks for the last 40-some years were really the prime cause of all this excess financialization and speculation and financial market growth, providing virtually free money for the least excuse to banks, which then got redirected into financial markets. My book here in January, The Scourge of Neoliberalism, kind of pulls all those threads together and looks at what is the unique mix of fiscal, monetary, industrial, and trade policy that is characteristic of neoliberalism, which came on the scene in the late 70s, early 80s, and gave global capitalism, particularly American capitalism, an extra life of 3 or 4 decades here, globalizing and financializing and repressing real wages and destroying unions and so forth. But how that's come to an end here, and how Trump's policies are really best understood as neoliberalism 2.0, a more aggressive, virulent form of neoliberalism, but that will fail as well. And in the 2020s decade ahead, we're going to see something really significantly different, I believe, than neoliberalism. That could be, even more reactionary, more corporate, neo-fascist-like, or it could be more progressive, and that's the battle of the coming decade. So that explains, the broad thrust of my work as far as the book publications are concerned. But that's the background. If you look at what's happened here, of course, a big event today. Global financial markets are imploding everywhere. But back up a little bit to 2019, if you would. And, the conditions were already ripening there. The global trade was slowing dramatically, partly due to Trump's trade war, but fundamentally apart from that as well. Global economies were sinking into recession. Japan was already in recession again. Europe was stagnating at best. China was slowing down. India having trouble with its banking system. And the U.S. economy as well was slowing down. I'm talking about the real economy, consumption and real investment. And all that was holding it up in the U.S. was really consumers. And the reason why consumers were still holding on, I argued, was because at the top end of households, you had this massive bubble in wealth created by stocks and other financial assets. That's called the wealth effect. But only people who have stocks actually affects their consumption. But the rest were really being held together, other households, median and below, because of credit. And if you look at the defaults on credit cards as one symptom for middle and below, they're at around 9%, which is just as bad as they were during the 2008 crash. So consumption due to credit was keeping things going for the rest of the consumption economy. But real investment was contracting for 9 months last year, despite the fact that Trump had passed a multi-trillion-dollar tax cut for investors and businesses and corporations, the wealthy 1%. Multi-trillion, because my calculations show it was really $4.5 trillion over a decade, not the announced $1.5 trillion, which is an underestimate that doesn't count really the multinational corporations tax cuts offshore, and assumes that we have this massive 3 to 4% growth for a whole decade with no recession. No, it's absurd. So massive tax cuts under Trump, which had the effect of causing a further artifact in the stock markets and a further bubble, because most of it went into financial assets and stocks, most of those corporate tax cuts. Fortune 500 tax profit figures for 2018 were 27%. 23% was due to the windfall tax cuts alone. So most of that went into financial assets and caused a bubble in the stock market. And of course, the bubble occurred under Trump in 2017 as well as 2018. 2017, it was anticipating the tax cuts. In 2018, it was the tax cuts. 2019, Trump gave him another $427 billion in loophole tax cuts. And he then forced the Federal Reserve to back off of raising interest rates in 2018-19. And what we got in 19 was further free money from the central bank to bankers. So you got all this free money flowing into bankers and flowing into investors, and all this subsidized tax cuts flowing into investors. And that produced an artificial financial bubble in the stock markets and other financial markets as well that we're now seeing unravel. Okay, artificial boom, and now it's unraveling. It's not unlike what George W. Bush did, boosting up financial markets and housing before 2008. Trump's done the same thing here. And we know what happened with Bush and the crash that occurred. And then, of course, we had Obama and the Democrats bail out the banks big time, and the Fed bail out the banks, and Main Street kind of got dribble, a little bit here and there, and we got a very weak recovery.
Could we just go back? You mentioned, the 2008 financial crisis, which probably actually you could start to see it, or some people started to see it, like yourself, I think, as early as 2006. Explain a little bit about, there were these bizarre financial instruments which no one understands, and there was related to this issue of junk bonds. Are we past all of that now?
No, we're repeating it, except now it's the corporate, non-financial corporate sector and junk bonds and triple B bonds that are at the center of this credit problem. Before, with George W. Bush, of course, it was subprime mortgages in the housing industry, construction that was at the center of it, but it was really the derivatives of financial markets underlying the problem with housing and junk. The subprime mortgages. And now you got subprime junk corporate bonds here. The virtual free money under Obama by the central bank, which was like 0.1% for 6 years, allowed banks and non-financial corporations to borrow huge amounts using corporate bonds and to speculate with it in financial markets as a result, as I said, right? But almost $1 trillion a year added in bonds for 6 years. And a lot of those are junk bonds. Junk bonds are when a company is in bad financial and economic shape, probably should go out of business, but they get this easy money from the bankers, but they have to pay a high price for it. Therefore, it's called high yield or junk, right? And they can bump along and survive as long as the economy is good, keep borrowing and keep rolling over and refinancing the junk bonds. But when you enter a period like now where you have a crash in bonds and financial assets, they may not be able to roll it over to refinance. As those companies that had overinvested in subprime mortgages couldn't get someone to bail them out, Lehman Brothers, Bear Stearns, and so forth, and that AIG, that ended up in a crash in 2008. Well, we're about to see the same thing here in the credit markets, but now it will be junk bonds, high-yield bonds, and what's called triple B corporate bonds, which are really mostly junk as well, about $5 trillion.
Help me understand why, in a period when my perception is that profitability of corporations has gone up significantly, and yet you're saying that there's this huge amount of corporate debt out there. I mean, why weren't corporations able to simply self-finance if they were so profitable?
Well, because the cost was so low, the banks were just a couple percent maybe. The banks would get money from the Federal Reserve for 0.1%, and then they would loan it out to companies 2-3%, right? And it was so cheap. The money was so cheap. Corporations were borrowing, issuing bonds, which is borrowing, right? And then turning around and using the borrowed money on their bonds to enrich their shareholders, their stockholders. A good example is Apple Computer, sitting on $250 billion in cash, still issuing corporate bonds, turning around and then paying the shareholders out of the money for the corporate bonds. And by the way, the tech borrowed money and then bought back their stock. Borrowed money using bonds, bought back their stock, right? 70% of that stock buyback went to them, the senior managers of the company. It wasn't as if they were buying it back from, shareholders at large. They were buying it back from themselves. And of course, the buybacks drove up the price and gave them a nice, quick capital gain.
This is all an alternative to job creation, too, then. So this is not a form of investment that
Pardon me?
This was not a form of investment that led to job creation then either.
No. This is all paper. This is all financial assets. But as I pointed out in my prior books, 21st century global capitalism has become very, very much this from speculating in financial asset price capital gains is so lucrative now and so easy to do. You jump in and out of these markets. It's not as if you got to come up with a new product and you got to have distribution channels and you got to have suppliers and you got to hire workers and it takes you a couple of years to start realizing income. No. If I just pump the money in these financial markets, I can turn a profit in weeks and days even. So they're all turning toward this. We got making money from money instead of making money from things, you see. And that's what's happened to the capitalism, and that's why it's becoming so financially unstable. But instability in the financial markets feedbacks back on the real economy as well when you have these financial crashes like we see going on now. The financial bubbles crash, they then cause a freeze up in the credit markets, and companies that are making things and hiring people can't get loans in order to keep their businesses going, you see, and they have to start laying off. And that means you've got the financial crisis and crash spilling over into the real economy. And the collapse of the real economy then feeds back once again on the financial markets, and you're in a downward spiral, you see.
So there's the view out there, this is all caused by the coronavirus, which is a trigger, right? I mean, it's probably understood as something which has upset this house of cards, then followed by what was unexpected by most of us is this sharp decline in petroleum prices with some kind of a petroleum price war going on between Russia and Saudi Arabia.
Yeah, well, you got to distinguish, as I do, between different kinds of causation. You know, there's what I call precipitating causes, enabling causes, and fundamental causes, right? The fundamental cause is the financialization of the global economy and the lack of real investment going into job creation. Coronavirus was a precipitating cause. In other words, the global economy the real economy was already growing weak in the U.S. And in Europe and in Japan, and it was becoming more fragile. So we had the big financial stock bubble piling up on top of a weak real economy. So when the coronavirus hit, what it did was break supply chains, which means production declines, and it also started impacting consumption demand, which exacerbates all that. So the coronavirus causes the real economy to take a bigger hit. Well, when it takes a bigger hit, that means corporate profits are going to decline here or slow down because of supply chain breaks and consumption demand weakening. And when it slows down and corporate earnings slow down, that's a signal to the stock markets, no more corporate profits here. The 11-year boom and bubble is over, and investors, professional investors, take their money and run to the sidelines and cash in, you might say, their big wins. It's like at a casino, they really hit it big. Smart players will take their money and leave the table. Okay. And that's what they do. And that's when you have the collapse.
Well, we're talking with Dr. Jack Rasmus, obviously an economist. And Jack, I mean, in terms of most of us who do not have big investment, how is this going to impact most working people in this country and around the world? Of course, we are also facing situations where many of us are going to be told we need to self-quarantine, and in the United States, where we don't have meaningful paid sick leave for most working people, particularly low-income people, that means we're not going to have money to pay the bills. It also means with the decline in world trade or the shutting down of plants and whatnot, there's going to be large numbers of layoffs. What is this? Where do you think this is going to go for the rest of us?
Well, you got to distinguish between the coronavirus effects on working class, and you got to distinguish between the financial asset collapse. They're related, but there's two different kinds of effects, okay? The coronavirus, as you pointed out now, we have the supply chain break problem, which means factories and companies can't get what they need of intermediate goods, and so they start laying people off, right? You got the demand impact here from the virus, most obvious in the travel industries, hospitality, and so forth, but now affecting retail, restaurants, and so forth, spreading, in other words, entertainment sectors and industries, people staying home, not buying. I mean, the malls in California are just about empty. So that's two effects. But then, what's going to exacerbate that are these rules about, you got to stay home, right? You got to sit, you can't come to work, employers will say, for 14 days. Or if you feel sick and you go to the hospital and they say, oh, you got the virus, they'll tell your employer, and your employer will say you got to self-quarantine for 14 days. Now, working class folks can't afford that. First of all, the U.S. is the worst country in the industrial world for paid sick leave. We just don't have much. Even in a union contract, maybe you got 6 days, or 7 days. But most people don't even have that. And according to the Federal Reserve, over half of the families have $400 or less in emergency funds. Well, this is the emergency. They can't afford to miss a day. So they're going to be sick. And they're not going to tell anybody, and they're not going to go to the hospital to get a test. First of all, they can't go to their doctors to get a test because doctors don't want them in the office. They can't do anything for you anyway. There's no vaccine, and they don't want you to infect everybody else. So your doctors are turning people down. So you got to go to the hospital. Well, when you go to the hospital, an emergency room to get tested and everything, just to get into the hospital and get some tests, it's going to cost $1,000. People have no insurance. Go ahead.
Something like 87 million people in this country either are not insured or are underinsured. So the copays and the deductibles are out of the question.
Yeah, 30 million have no insurance at all. But even if you have insurance, most of them are $500, $1,000 or more deductible in copays, right? And you're going to go to the hospital. You know the cost of going to the hospital, even if you have insurance. If you got to go to emergency, right? It's not covered. And this recent legislation does not protect people that way. So, you're not going to go to the hospital. You can't afford that. And what about the other factor of shutting down the schools? Schools are shutting down left and right. Colleges are beginning to do it now, too. But what about families with K through 6 kids, kindergarten through sixth grade? They can't afford nannies. They can't afford babysitters. They have to take off when the schools shut down. Can they afford to take off? Who knows how long the schools are going to stay shut down? Can they afford? No. If they only got $400, they can't afford to take a day off from work. For even if they're sick, even if they're not sick, when the schools shut down, they can't afford it. They can't afford the hospital costs to go. They can't afford being quarantined for 14 days. Quarantining may slow things down a little, but it doesn't work. If you don't believe me, just look at Italy. Northern Italy, now 10,000 cases of infection in 2 weeks. 10,000. It's worse than South Korea and Iran. It's second only now to China. They got the whole country on lockdown. You're not supposed to go anywhere. Yeah, come on, fool me now. People are going to go to the grocery store. They're going to go and do the things that are necessary. It's not going to stop it, in other words. Quarantining does not work in terms of really containing this. Nothing's going to contain this. And what the government should be doing, if it wants people testing, is to say, go to the hospital, get tested. The government will bill the hospital, or the hospital can bill the government. Not what they got now, which is, pay out of your pocket and ask the government to pay you back. No, workers aren't going to fall for that one either.
Brief leap into politically what this means in this country. I mean, you've got a president he actually has great credibility among a significant minority of the population who believe that his policies have led to a strong economy and low unemployment. On the other hand, you've got a Democratic Party, fundamentally different views and programs between the Biden and Sanders approach. Quick thoughts about all of that?
Yeah, I mean, look at the last 20 years. Republicans come into office, George W. Bush, right? He destroys the economy, makes his rich buddies, even richer. Then the Democrats come in, Obama, bails out the banks, bails out the corporations, bails out the wealthy, and it takes, then it's not fully recovered. Well, then you get Trump coming in, and he does the same thing as Bush. He gives these massive tax cuts and all these other policies, enriching the George Bush buddies even further again. Right? And now we're at the same repeat in the Democratic Party, and the choice is either Biden, who it looks like is going to prevail, who will do the same weak, tepid, warmed-over solutions that Obama did, or the party can choose Bernie Sanders, who's proposing a fundamental change. Bernie wants to restructure the Democratic Party into an FDR-like party. In other words, back to its roots. But this is a corporate party now. Ever since Bill Clinton in the 90s, DLC, Democratic Leadership Conference, the corporate wing, the money bag wing, took over that party, and it's been proposing a weak corporate-like, corporate-light solutions ever since. And that's the choice before that party right now. We only have a one-party system, in my view, and we got two corporate wings of it. One's the Republicans, although I'd call them Trump-publicans now, because he owns that party. And the other is the corporate wing, the DLC wing in the Democratic Party that's in this fundamental life and death fight with the Sanders wing, who wants to return that party back to its pay some attention to the working class roots. And that's the fight going on there now. I'm not very optimistic about Sanders prevailing because, the Democrat leadership is holding in his back pocket 500 special delegates, and guess which way they're going to throw those delegates in the convention in July. The strategy has been to split the vote until, in the primaries, until they see that it's an opportunity to pull the vote back again behind their always prime candidate, Biden, and give him a big push, which they did last week, you see. So that's what's going on now, and I'm afraid they're going to, deny Sanders once again the nomination. And if they do, they will have shot themselves in the foot because the young folks, the millennials, the Gen Xers and Zers who are behind Sanders, regardless of their race, behind Sanders, they're the ones who have been really getting it in the ear with these policies. The millennials and others are the ones who are really suffering from these policies, more so than the rest. And they will abandon the Democratic Party in the election in November if Biden is the candidate, and therefore the Democrats will lose again. Once again, putting up a candidate who cannot win as they did with Hillary. And that's the crisis, political crisis before us.
I'm actually quite concerned, given the sort of political dysfunction from a working class viewpoint, from working class interests. We face a dual crisis in both the financial and real economic sectors. It strikes me, unfortunately, like terrain which could feed frenzy on the far right.
Could very well be. And that's what I've called one of the two options in the coming decade, in the 2020s, right? You could see a strengthening of neo or proto-fascists, I'd call them, and proto-fascist economic policies that would make Trump's policies look liberal. That's one possible direction. The other possible direction, which and forces are building there, is towards a more progressive outcome. And they are building. Those forces are building mostly based on younger people and minorities, younger minorities, by the way. And, they are going to get hit hard in the next decade. You think it's been bad for the millennials and Gen Zers in the past with all this contingent labor? We've got 60 million part-time temp workers out there with no benefits and working 2 and 3 part-time jobs, indentured student debt, can't afford housing, certainly can't afford health care. It's going to get worse. Why? Because what we got is new technology coming online called artificial intelligence. Intelligence will eliminate 30% of the occupations by the middle and late decade coming. 30%. Now, that's not my forecast. That's the corporate McKinsey consultants' forecast.
Final thoughts in the last minute here.
I think that the forces of progressivism, particularly and the young. And if the Democratic Party puts up Biden and loses, I think the prospects for forming a real bona fide, real bottom-up third party, it will be on the agenda.
Well, thank you very much. At least that's one positive possible conclusion to this really otherwise pretty scary terrain. Thank you, Jack Rasmus.